Stock markets are crashing. We're seeing a lot of people moving into cash. Is this a correct move, as maybe that's not what the data shows? A running theme of things you'll see on this channel and other similar channels is highlighting the issue of investing with emotion and how you need to be data driven and sort of strip out your emotions and make sure that you're thinking logically. It's easier said than done, and that's why I want to go through some data that I've collated and we can have a discussion of what this means given the recent economic downturns and all the issues with tariffs. And a quick note, I do have a cold, so that's why I sound nasally, but wanted to persevere and still keep the content going. So on screen, you'll see a graph of the annual returns of the S&P 500 index over nearly 100 years. And what this is mainly to highlight is what we've seen recently is a 20% peak to trough, and this is recorded on the 6th of April, so we'll wait and see what this means going forward and where the markets move. But we've seen increases, we've seen 20% drops before, and we've seen, in excess of that. What I think a lot of people say is that it's about a 9% on average return, or 10% here as it shows as an annualized average from the S&P 500, which is sort of gold standard index to be used for these discussions. But what you want to highlight here is that it does very rarely actually receive 10%. What you get is good years and you've got bad years. And I think in times like this, when we seem to be heading in a downtrend, you sort of need to think long term and make sure that you're not acting too rationally in terms of the short term. Have a think about how you've performed historically and where you think it may go in the future. It's not worth reacting based on 1 week potentially of bad news. But as I always say, this is not investment advice. Again, following on from this, what we see is we are down 1 every 4 years, and we're down over 10% 1 every 10 years. And what we are currently looking like is we will be in one of those every 10 years that we are more than 10% down. We had a very, very good year last year, and we've had a very poor start of the year this year. It's reasons like this why I always say that you need to dollar cost average in, and if you don't know what that is, there's a separate video about it on this channel. But essentially, you do not want to lump sum invest unless you think you'll be able to time the market, or you're swing trading. For long-term investing as opposed to short-term trading, you really want to DCA in and to some degree DCA out. And it's for reasons like this. It's not 9% every year like you would maybe with a savings account. You've got highs and lows, and you need to be mentally and emotionally prepared for that. So looking at annualized returns is slightly flawed because there are significant intra-year movements, but any even beginner investor will soon realize is that the markets do not move in a linear fashion throughout the year. We have big peaks, big troughs, and then, obviously there are closes, and, that's when the annualized returns are calculated. But if we look at this, what we see is intra-year, meaning within the sort of 12-month period within the calendar year, we see gains far in excess of 20% up, and we also see losses more than 20% down pretty frequently. The current year is not shown in this, but what we're seeing, 10% is marked here, 20% you can also see. They are more frequent than you would probably think. The last time we had one of this scale was the start of COVID. But this is not a freak, one-off black swan event. These are, to some degree, cyclical events. They occur. There is a lot of history of them happening, and they will happen forever into the future. That's a constant thing that anyone would say. The reasons why this is happening is where the differences lie. Just staying with that topic for a second, the one thing, so if I look at the data on here, it was COVID last time. We had the 2008 financial crisis, the things like the dot-com bubble. There was something in 2011 as well with US credit ratings. And these have always had one thing in common, and that is they are, to some degree, they are external events. They are not things that are deliberately caused by any party themselves. GFC, for example, was credit rating agencies and other things. It was a housing bubble. That's not necessarily something that anyone controlled or desired. Same thing with COVID, same thing with the dot-com bubble. It's a lot of it stems from emotions, whereas, maybe, lack of clarity with some market participants. But what we see now is a localized issue, a stock market, crash or correction, whichever, sort of category you want to put it in its current state, that is caused by one person, and meaning Donald Trump, and a person in Donald Trump that is very financially illiterate and is seen to be someone who is benefiting the markets. When he got in, the markets rallied, and that's what is unique about this, is that this is to some degree a self-imposed thing. Trump knows to some degree the impact that this would have had on the markets, and that's why I think some people are more worried than usual. This is something that is unprecedented in the type of thing that is moving the markets. We've not seen something really to this degree, or not for a long time. The benefit of that is because it's something self-imposed, it is something that could technically be removed. Trump could get up tomorrow morning and say, we're scrapping the tariffs, and we would expect some recovery back up to roughly where we were a month ago, for example, in the markets. Somewhere around there. Obviously, the markets were pricing in tariffs to some degree, but not to the extent that we've seen. But then again, the other thing is we are 20% down roughly as of the 6th of April on a peak to trough basis. There is still news to come regarding, China has done reciprocal tariffs. There are other countries, and really it does appear that it's going to get worse before it gets better. It is probably my take on it, and I think that's something that is largely shared by most people. Again, so this is another bit of data. Stock market losses 5% or worse. That happens 90%, 95% of years, and this is looking at intra-year. 10% or worse happens in 63% of times. The 20%, which is where we are now, is 1 in 4, 26%. It's the 30 and the 40, which hopefully, I think for most people, we don't want to get to that point, but it's those edge cases that we could be heading into. But where we are now is a 1 in 4 year phenomenon. And that roughly aligns with COVID in 2020 to 2025 now. It is not a freak accident, and it's making sure that that you're emotionally prepared for this and you have a plan. And I think the thing is that since COVID and since apps like Trading 212, we've got so many more market participants and people in the market that have never experienced this happening before. And this is why videos like this are useful, not to tell people what to do, but to make them aware of some of the things some of the benefits of how they choose to act. Because what we are seeing is a lot of movement to cash, people moving to safe space assets like gold, even though gold has also dropped. But whether that's good or not is, based on your own situation, but there are some reasons why that may not be the best option. So here we go. So this is the MSCI World. So this is looking at something slightly different to the S&P 500, but they are largely correlated, the two of them. And what we're seeing is that up to 20% decline is where we are now in the middle of this, and we see the average after the decline, we have 17.7% as a 1 year return afterwards, 24% after 3 years, and 49% after 5 years. And what this is basically highlighting is the general thing that we see for sort of strong fall markets like the S&P 500, etc., is that they do recover. It's not common that markets drop and remain low. They do tend to recover, pick themselves back up, and often recover very strongly, like they did after COVID, to get us to the position we are now. Though it has to be said that this isn't always a foolproof strategy. The Nikkei, the Japanese stock market, has struggled for a prolonged period, and that is a major market. It is not something you can just lump your money into and just assume it will come back to you, but that's what the data shows is most likely. The other thing is to also think about your time horizons. Are you going to be invested for 5 years, 3 years, 1 year, 2 months, a week? When we need the money, what are you investing for? That is very, very key to how you can act in these situations. The longer time horizon you have, generally, the more you can put in now in terms of reducing your volatility. Because the market is at a massive discount, it's appealing to people, but you need to think, will I get this back? Will it drop further? And this is a graph that touches on a lot of what I've said in this video, and the general theme of this video is about moving the flight to cash, the movement to cash. This is basically a graph showing the issues and the impact on performance of being out of the market. As the old anecdote goes, timing the market or time in the market is better than timing the market. And this is a situation now where a lot of people are trying to time the market. They try to get out when they think it's good to get out and get in, given the volatility when they think it's good to get in. A lot of people are not sticking with their investments for the long term. And it's things like this that the data shows here, the risks of doing that the flight to cash, to go and get your 4 or 5% on cash, is less volatile, but it does expose you to missing out on a lot of returns, and the opportunity cost of doing that is huge. But this is what we see: 10.4% and average annual returns on if you're fully invested, 6.1% if you miss only the best 10 days, and 3.5% for 20 days, and it goes down. And the other phenomenon with this is that the best days often do happen to come close together. Generally, it's prolonged periods of growth. So it's something to think about. But what it's basically saying is that the data shows that being in cash is not the best for prolonged returns. And when you need to think about this, you think about it with the effect of accumulation and everything. Over a long term, the cumulative effect of all of this will be even greater. I think it's quite clear in the data that the flight to cash that we're seeing at the moment is probably not the best for the long term for most people. And generally, most people should sit through the volatility and ride it out. Won't always work, and you obviously need to do your own research, but that to some degree is what the data shows. But then again, you could always get data that does show the inverse. There's no one size fits all policy. And the difference is, and the worries this time, is the cause of the volatility. This is not something external. This is something that's been thought about, acted on deliberately, and this is something that it's hard to obviously impact or measure the impact of that on the market, but that is something that people are acting differently in the market because of, and it's good to be aware of that fact. But anyway, it's been Harry from HL Tech. Please like, comment, subscribe. I really appreciate all the support on this channel, and I'll see you next time.